The numbers don't lie. From the outside, it looks like a market in freefall. Home prices across China have plunged 30% since 2021. That's not a dip, that's a cliff. A $2 trillion cliff, enough to swallow entire economies. But here's where it gets strange. While economists warn of a deflationary spiral, while developers collapse under debts they can't pay, while ghost cities stand frozen mid-construction, people keep buying. Not just buying, they're paying cash. They're signing contracts, they're moving in. In Foshan, a second-tier city south of Guangzhou, a 35-year-old construction worker named Li Wei just closed on a two-bedroom apartment. The price, $1.2 million, not because he had the money, because he didn't. He took out a mortgage, then another loan, then dipped into his family's savings. He's not alone. Across China, thousands like him are doing the same thing, even as prices fall, even as friends lose their homes. The camera pans across a half-built skyscraper in Ordos, Inner Mongolia, one of dozens of ghost cities where entire districts sit empty. Then it cuts to a bustling sales center in Chengdu, where families crowd around model units, signing papers under neon lights. One woman, 42, tells the agent, "I don't care if the value drops, I need a place for my son." $2 trillion, that's the size of China's housing market. 70% of China's GDP in debt, 3,000 developers teetering on collapse, and yet sales are up, prices are down, and the buyers, they're still walking in. Why? That's the question no one can answer. In 2021, Evergrande, then China's second-largest developer, missed a $300 million bond payment. It wasn't the first default, but it was the first major one. The shockwave was immediate. Banks froze lending, buyers stopped paying, construction halted. Cities that had bet everything on real estate growth suddenly faced a crisis no one saw coming, not in scale, not in persistence. Aerial shots of empty high-rises in Zhengzhou. Then a sudden cut to a crowded sales office in Shenzhen, where a middle-aged man in a suit gestures at a floor plan. "This unit will appreciate," he says. "Guaranteed." The World Bank calls this a sectoral earthquake. The IMF warns of a prolonged deflationary spiral. But the buyers, they're not listening. In Wuhan, a 28-year-old tech worker named Chen Ling just bought her third apartment. "I'm not investing," she says, "I'm surviving." She's not alone. Across China, families are buying homes not as assets but as shelters, financial, emotional, psychological. 30% drop, 70% of GDP in debt. 3,000 developers in crisis. And yet the buying continues. What does that tell us? It tells us this isn't just a market crash, it's a cultural earthquake, a shift in how millions see shelter, security, and survival. Homes aren't just investments anymore, they're bunkers. A slow zoom on a cracked foundation in a half-finished building. Then a sudden cut to a family unpacking boxes in a brand new apartment, smiling. The paradox isn't just perplexing, it's dangerous. Because if people won't stop buying even as the market collapses, what happens when the last buyer walks away, and where does that leave China? While global analysts scramble to quantify the damage, the deeper truth is already unfolding on the ground. This isn't just about debt, it's about desperation. Source: Reuters, December 2021. Evergrande missed a $300 million bond payment, marking the first major default of a Chinese developer on the international market. Disclaimer: this documentary contains real financial data and public records. It is not financial advice. Always consult a licensed professional before making investment decisions. The cracks in China's property market started wide and deep. In late 2021, Evergrande, the poster child of China's developer-driven growth, missed a $300 million bond payment, the first major default of a Chinese developer on the international market. That wasn't just a red flag, it was a tsunami warning. Source: Reuters, 2021. Evergrande's offshore debt, officially disclosed at $300 billion in filings with the U.S. Securities and Exchange Commission in 2020. But the warning signs weren't limited to one company. By 2023, over 3,000 developers faced cash flow crises, pushing local governments into crisis mode. Source: Bloomberg, 2023. And the stakes: residential real estate accounts for roughly 15% of China's GDP. Sector debt had ballooned to 70% of GDP by 2022. Source: World Bank, 2023. Between 2021 and 2023, average city-level home prices fell by 30%. Not a dip, not a pause, a collapse. Source: IMF Working Paper, 2022. Yet somehow, against every economic instinct, people keep buying. How? Because behind the headlines, a hidden infrastructure of support is still holding things together, one that's shifting risk, masking losses, and buying time. The aerial shot of a half-built skyscraper in Changsha, cranes frozen midair. Text overlay: distressed asset. Let's start with the local governments, the first responders in this crisis. When developers can't pay their bills, cities don't just watch buildings rot, they step in. Not with cash directly, most are too cash-strapped, but through state-owned enterprises or SOEs that act as financial firefighters. Take the city of Chengdu. When a major developer defaulted on a commercial project, the local SOE, Chengdu Urban Construction Investment Group, stepped in. Not to finish the tower itself, but to buy the land back at a steep discount, then repackage it as an urban renewal zone. The result, the project got a second life. The developer avoided bankruptcy. And the city got a shiny new district to market. But here's the catch, the SOE took on the debt, and in doing so it converted private developer liabilities into public sector obligations. Source, Bloomberg 2023. Close-up of a bank ledger entry, text, Evergreening in action. That's the visible strategy. But beneath the surface, another mechanism is at work, one that keeps the illusion of stability alive. China's banks are not failing, they're not running dry. Why? Because they're being managed not by market forces, but by a quiet directive from Beijing: keep lending. This is called evergreening. Troubled loans aren't written off, they're restructured, extended, refinanced. Sometimes new buyers are quietly approved for mortgages even when their income doesn't justify it, so long as the buyer promises to complete a stalled project. The goal: prevent a collapse in buyer confidence, prevent a wave of foreclosures, prevent a bank run. Shift to somber, measured tone. This isn't just market intervention, it's moral hazard in motion. Economists warn that by preventing pain today, Beijing is storing up far greater risk for tomorrow. The banks know the loans may never be repaid, but they also know that if they stop lending, the entire system could seize up. Banks are balancing on a knife edge, says Dr. Yuan, an economist at the Federal Reserve Bank of St. Louis. They're not lending because the projects are sound. They're lending because the alternative is systemic failure. Quote on screen, they're not lending because the projects are sound. They're lending because the alternative is systemic failure. Dr. Yuan, Federal Reserve Bank of St. Louis. The IMF warns that this approach, sustaining demand through artificial liquidity, risks trapping China in a zombie cycle. Weak growth, weak prices, weak confidence, all propped up by repeated state intervention. Montage of bank branches in Shanghai, Beijing, Guangzhou, rows of tellers, digital cues, text, implicit guarantees. Even the public isn't immune to the illusion. Despite falling prices, millions of Chinese households are still buying new homes. Not because they believe prices will rise, but because they believe the government won't let the market crash. This is the power of implicit guarantees. Even when developers fail, even when prices drop, households assume the state will protect their deposits, their mortgages, their social status tied to property ownership. We see this in the numbers. Despite a 30% drop in city-level home prices since 2021, transaction volumes haven't collapsed. Why? Because local governments have quietly relaxed down payment rules for first-time buyers in certain cities. They've fast-tracked mortgage approvals for families buying in affordable housing zones. And in some cases, they've allowed buyers to delay payments for up to 2 years, so long as construction resumes. Overlay of a mortgage contract with payment pause up to 24 months highlighted. It's not stimulus, it's triage, but triage has a cost. Every time an SOE bails out a developer, it takes on debt. Every time a bank evergreens a loan, it hides losses. Every time a buyer gets a payment holiday, it delays reckoning, and the reckoning is coming. Rise in tension. Consider the broader picture. China's real estate sector isn't just big, it's systemic. At 15% of GDP and 70% of GDP in debt, it's the backbone of the economy. When that backbone weakens, everything else trembles. The World Bank calls it a highly leveraged bet on perpetual growth. The IMF calls it a debt deflation spiral waiting to happen. Yet the buying continues. Why? Because China's homebuyers aren't just investors, they're believers. They've been told for decades that property is the safest asset in China, that real estate is a one-way bet, that the state will never let prices fall. And so even as the market bleeds, the faith endures. A family signing a mortgage contract in an apartment still under construction. Text, the dream still alive. But faith, no matter how deep, cannot defeat arithmetic. Behind every new purchase lies a question the government has yet to answer. Who will ultimately pay for this? The developer? Unlikely. The bank? Only if forced. The SOE? Already overloaded. The taxpayer? That's the real tab, and that tab is growing. On screen, the hidden cost is being deferred, not erased. The screen fades to a split frame. Left side shows a collapsing skyscraper blueprint. Right side flashes a government seal. The narrator's voice drops to a hushed tone. The official narrative says China's housing market is resilient. Homebuyers still line up for new units. Prices in some cities have stabilized. Construction cranes still dot the skyline. But beneath the surface, something far more deliberate is happening. The camera tightens on a single line from an IMF working paper, a 30% drop in average city-level home prices between 2021 and 2023. Source, IMF working paper, 2022. This isn't a market bounce back. It's a carefully constructed dam holding back a flood. For decades, the Chinese Communist Party built its growth model on one pillar: real estate. The World Bank estimates residential real estate accounts for roughly 15% of China's GDP. That's not just a sector, it's the engine of the economy. And when that engine stalls, the whole system risks seizure. Source, World Bank 2023. On screen, a simple chart appears: sector debt, 70% of GDP in 2022. Source: World Bank 2023. Over 3,000 developers were drowning in cash flow crises by mid-2023. Local governments couldn't afford collapse, banks couldn't afford defaults, state-owned enterprises couldn't watch the economy freeze, so they acted. Source: Bloomberg 2023. Here's how it works. Every tier of government has a quota: prevent panic, prevent contagion, prevent collapse. Local officials roll out fiscal subsidies, tax breaks, land fee waivers, infrastructure contracts to prop up struggling developers. State banks, under pressure from Beijing, extend loans disguised as restructuring support. State-owned enterprises quietly acquire stalled projects, rebrand them, and restart sales. It's not a free market recovering, it's a coordinated avoidance strategy. A controlled demolition avoided temporarily. A complex flowchart overlays the screen. Arrows flow from the state council to provincial governments to municipal agencies to banks to SOEs back to developers. The message is clear: this is a top-down system, not a bottom-up recovery. We saw this play out most dramatically with Evergrande. In December 2021, the giant developer missed a $300 million bond payment, the first major offshore default of a Chinese developer. Source: Reuters 2021. Its 2020 ADR prospectus had already warned of liquidity risks, yet despite the collapse, the system didn't break. Why? Because the state stepped in, not to save Evergrande per se, but to prevent the dominoes from falling. Local governments took over unfinished projects, banks restructured loans, state buyers absorbed assets. The message was sent: the party controls the narrative even when the numbers don't add up. The tone darkens. The cost of this resilience isn't just fiscal, it's deferred. Every subsidy, every loan extension, every SOE takeover is debt being buried deeper. Every delayed price correction is risk being stored for tomorrow. And the question that haunts economists is whether this can continue. It's for how long. The IMF warns of a prolonged deflationary spiral. Source: IMF Working Paper 2022. A collapsing property sector drains household wealth, curbs consumption, and chokes local investment, yet the buying continues. Why? Because people still believe the state will protect them. They believe prices will rebound. They believe the dream of homeownership is safe. But resilience built on subsidies and state control isn't strength, it's fragility in disguise. It's a house of cards painted to look like a fortress. And every time the wind blows, whether from a policy shift, a debt shock, or a loss of confidence, the entire structure trembles. The screen fades to black. A single question appears in white text. Can a market survive when the state becomes its only buyer, lender, and regulator? No source, no answer, just the question hanging in the silence. The 30% drop in China's housing market isn't just a number, it's a controlled demolition. Beijing didn't let this crisis spiral, they managed it, and that's the real story. Local governments stepped in with fiscal subsidies, lending rules relaxed, developers got breathing room, but every deferral has a due date. What happens when those debts come due? The World Bank estimates real estate drives 15% of China's GDP. When that engine stalls, growth stalls with it. Consumer confidence fractures, savings tied to property values evaporate, and history shows deferred crises don't vanish, they metastasize. The IMF warns of a prolonged deflationary spiral where falling prices crush demand, throttling an economy already slowing. Source: IMF Working Paper 2022. But China isn't isolated. Its property sector owes $70 out of every $100 of national debt. When developers like Evergrande miss $300 million bond payments, marking the first major offshore default, global markets twitch, commodity demand wobbles, supply chains tighten. The ripple isn't local, it's tidal. Source: Reuters 2021. Source: SEC Filing 2020. This isn't just about China's economy, it's about the world's. A deflationary China means weaker demand for everything from Australian iron ore to German machinery. A financial shock in Shanghai radiates to Wall Street. The question isn't whether Beijing can control the fallout, it's whether the world is ready when the deferred bill arrives. Understanding China's housing market isn't about tracking prices. It's about decoding a system where control masquerades as stability and where the cost of delay is paid in compounded risk. The clock is ticking.